Imagine retiring truly rich. When comparing dividend powerhouses SCHD and Fidelity's ETFs, which one actually puts more money in your pocket long-term, securing your wealthier future? Let's uncover the investment that might just make you significantly richer. Why is dividend investing so compelling for retirement? Picture this: a steady stream of passive income year after year, irrespective of market volatility. These are companies consistently sharing profits with shareholders, offering a tangible return. This isn't abstract growth, it's cold, hard cash. This cash can be reinvested to buy more shares, creating a powerful compounding effect, or directly used to cover living expenses during your golden years. Think of it as your money diligently working tirelessly for you, consistently generating more money. This mechanism, applied correctly, transforms modest savings into substantial wealth and enduring financial security. Many investors mistakenly chase volatile growth stocks, overlooking the quiet power of consistent dividends from companies with strong balance sheets and a long history of rewarding shareholders. This approach builds a robust portfolio foundation that successfully withstands economic headwinds and market downturns, providing crucial peace of mind and financial stability when you need it most in retirement. Our first contender, the Schwab U.S. Dividend Equity ETF, universally known as SCHD, has become a cornerstone for astute dividend investors. SCHD is a passively managed ETF tracking the Dow Jones U.S. Dividend 100 Index. Its methodology is rigorously defined, focusing intently on companies with a long track record of paying dividends, but crucially, it prioritizes quality. SCHD screens meticulously for fundamental strength, high cash flow to total debt, robust return on equity, and a minimum of 10 consecutive years of proven dividend payments. This isn't merely about chasing the highest yield. It's about sustainable, growing dividends derived from financially healthy, resilient corporations. Historically, SCHD has delivered impressive total returns alongside consistent dividend growth, firmly establishing itself as a premier holding for many retirement portfolios. Its remarkably low expense ratio further enhances long-term returns, ensuring more of your hard-earned money stays fully invested and compounds effectively over decades. Now, let's turn our focused attention to Fidelity's extensive dividend offerings. While Fidelity boasts several dividend-focused ETFs, we'll primarily examine the Fidelity Dividend for Rising Rates (FDVV) and the Fidelity Quality Factor ETF (FQAL) as highly representative examples. Unlike SCHD's purely passive index tracking approach, Fidelity often employs a more active or distinct factor-based strategy. FDVV, for instance, seeks income and capital appreciation by investing in companies with attractive valuations and strong fundamentals, particularly those expected to perform well in a rising interest rate environment. FQAL, on the other hand, concentrates on high-quality companies possessing sustainable business models and excellent financial health. These Fidelity ETFs offer valuable diversification and can sometimes capture different market segments or respond to specific economic conditions more dynamically than a purely passive fund might. The key difference lies in their active management overlay or distinct factor focus, aiming to potentially outperform a broad market index, offering unique advantages. Let's conduct a direct side-by-side comparison, meticulously laying out key metrics. When evaluating SCHD against Fidelity's dividend ETFs like FDVV, several critical factors emerge. First, expense ratios. SCHD is renowned for its ultra-low expense ratio, typically around 0.06%. Fidelity's offerings, while competitive, might hover slightly higher, perhaps 0.15% to 0.29%, depending on the specific fund. While these differences seem small, they compound significantly over decades, powerfully impacting your total returns. Second, dividend growth. SCHD has an exceptional and well-documented track record of consistently increasing its dividend payout year after year, a profound testament to its stringent quality screens. Fidelity ETFs also aim for consistent dividend income, but their growth rates can vary more depending on their specific strategies and holdings. Third, sector exposure. SCHD tends to be more heavily weighted towards industrials, financials, and consumer staples. Fidelity's funds might exhibit different sector tilts based on their active management or factor methodologies, potentially offering complementary exposure. Understanding these sector differences is crucial for robust portfolio diversification. Finally, consider the management style. Purely passive for SCHD versus more active or factor-based for Fidelity. This fundamental distinction dictates investment philosophy and potential for outperformance. So, the burning question, which one will ultimately make you richer? The honest answer, it depends entirely on your specific retirement goals, individual risk tolerance, and investment philosophy. If your primary objective is consistent, low-cost exposure to high-quality dividend growth companies with a proven track record, SCHD is an undeniable powerhouse. Its simplicity and robust methodology make it an excellent core holding for any dividend-focused retirement portfolio. You are essentially buying a highly curated basket of stable, profit-generating businesses. However, if you actively seek a more dynamic strategy, perhaps with a tilt towards certain economic conditions or a different quality interpretation, Fidelity's actively managed or factor-based ETFs could genuinely offer an edge. They might provide valuable diversification or aim to capture alpha that a passive index might miss. Ultimately, richer isn't merely about achieving the highest past return. It's about selecting the investment that best aligns with your long-term strategy, minimizes costs, and genuinely helps you sleep soundly at night. Before integrating either dividend giant into your retirement plan, conduct meticulous due diligence. Examine holdings, understand methodologies, and consider how they fit your financial picture. Which philosophy resonates most? SCHD's disciplined, passive approach or Fidelity's actively managed, factor-based strategies? Share your insightful thoughts below.